Hope you know a good place to live because I'm... Ooh, dear Lord. Because I'm looking to make a new start. Oh, Mother of God! Dear Lord! Woo!
Arrested Development may be a popular spot on the Netflix lineup, but the company disappointed investors yesterday when the subscriber growth numbers in its earnings report fell short of analysts' expectations. And it seems that the streaming video service's investment in content was at least partly to blame. But Heard on the Street's Miriam Gottfried is here to tell us that investors don't run away from the stock just yet. There's a likely plot twist to come later this year. Good morning, Miriam.
Good morning.
So, what are we likely to see from them?
Well, they said that their margins had been running higher, their margin growth had been running higher than they had sort of laid out. And I'm of the opinion that they need to be spending more money on content. And it sounds like that's what they plan to do. They said they plan to ramp up spending in the fourth quarter on content. And in the past, when they've done that, when they've done the big deals, that's really spurred subscriber growth.
I mean, it's one of those actually positive stories where more spending, more investment actually begets more growth and ultimately, you know, protects them. I think you say in your piece that scale is very important in Netflix.
Yes. So Netflix is an interesting case because it's still in the early stages of ramping up, you know, its business and getting, I mean, at least if you believe that it can get to 60 to 90 million subscribers, which is what Netflix has been consistently saying. So in order to get to that from under 30 million now, you know, for the domestic business, then you need to really be spending in order to get as much content as you can to drive people to your service.
Yeah, I find it remarkable that we talk about it like Netflix as if it is a startup with 30 million subscribers aiming for 90, and it accounts for something like 32% of all internet traffic.
That's right. It's a very interesting company in that respect, but you know, I've argued in the past and I continue to argue that it needs to be more like Amazon.com and sort of go for scale at the expense of margins at this stage.
Right, okay. So what would that mean in terms of content? Because a lot of focus obviously on their proprietary content, the Emmy nomination for House of Cards and of course Arrested Development as we just mentioned. Are they looking to build out more proprietary shows or is this literally
I think they'll probably do that.
deals?
I think they'll probably do that, but they need to really have more content of all kinds. They need to cast the net as wide as possible so that when you say, I wonder if that's on Netflix, it is.
Right. Right.
Yeah.
So we're talking about TV shows and movies.
TV shows and movies. They need to do, you know, sort of like the big Disney deal they did last year, that where people looked at that and said, "Oh, whoa, they're spending so much on this deal." That is the kind of thing that subscribers actually want, and that's what drives subscription growth. So they need to do more big deals like that.
All right. Sounds great, Miriam. Thank you so much.
Thank you.